Capital raising in private markets is notoriously slow. Founders and finance teams spend months dragging thousands of PDFs into sprawling virtual data rooms just to get a single deal off the ground. The problem with this process is that a data room only captures a specific moment in time. An audit is an artifact. It goes stale the exact day it is issued. Because that information expires, companies and private equity firms are forced into a repetitive cycle of manual labor. Every time a new transaction begins, they have to rebuild the entire diligence file from scratch. Traditional due diligence fails to provide a continuous record of truth. It operates as an expensive, temporary snapshot that creates friction and actively slows the flow of capital. Now, artificial intelligence is entering this pipeline. We have systems capable of ingesting raw data and building a complex company valuation in a matter of seconds. As these tools deploy, the market is suddenly flooded. We are entering an environment defined by instantaneous, virtually infinite financial analysis. But there is a significant blind spot in this processing upgrade. An AI can generate a model instantly, but it cannot tell whether the underlying evidence is real or entirely fabricated. Think of an autonomous vehicle hitting a blinding fog bank. No matter how sophisticated the AI brain is, it crashes without maps feeding it reality. As autonomous systems are tasked with sourcing deals and monitoring portfolios, they encounter a friction point. Their output is only as reliable as the inputs they are allowed to scan. The automation of capital markets reaches its limit not at the level of intelligence, but at the level of verifiable truth. To fix this pipeline, we have to look past the AI engine itself. The required upgrade is a new, rock-solid layer of institutional proof that can keep pace with digital processing. QuantPillar is built to be exactly this infrastructure. It acts as the evidence provider, solving the data bottleneck for the next generation of capital markets. The core mechanic eliminates the static virtual data room. Instead, a company holds a trust link, a living, continuously verified financial profile. For human lenders and private equity firms working today, this rapidly compresses diligence from months down to days. They can continuously monitor their current portfolio without ever starting over. Financial reality becomes a persistent, reusable asset that serves human dealmakers today and machine allocators tomorrow. To see how this infrastructure works, we need to break down the anatomy of a verified financial identity into its three essential traits. First, the identity is discoverable. The data is instantly visible to both AI systems and institutional screeners. No manual introductions are needed. Second, it is understandable. There is only one financial reality, and it is structured to be read exactly the same way by every single counterparty. Third, it is defensible. The underlying evidence is robust enough to hold up when critical capital and governance decisions are on the line. This infrastructure already holds $2.64 billion in verified value today, granting participating corporates a 41% better chance of landing capital. When these three traits converge, the resulting identity allows a company to move through institutional scrutiny without the friction of the old manual process. If we step back and look at the macro picture, the way value is assigned in the financial sector is changing. Historically, brilliant financial analysis was scarce and highly valued by the market. Now, AI systems are making that same analysis increasingly cheap to produce. Look at the supply and demand graph tracking the new market dynamics. Because AI makes analysis infinitely abundant and drives the cost down, the new scarcity, represented by this spiking line, is institutional proof. In this environment, the entity providing the verified evidence controls the underlying asset class that powers the automated market. For a company utilizing this infrastructure, due diligence is no longer a sunk cost. Their financial identity becomes a permanent asset that actively compounds in trust over time. They leave the legacy cycle behind. They no longer have to prove their operational reality from scratch for every transaction. They operate by the new rule of capital markets. Prove it once, benefit from that proof everywhere.